So Jamie, Amit, I'll let you guys draw straws in terms of who's going to take this one, but if you guys could just provide an overview of some of the accounting rules and guidance that's out there around valuation of harder to value assets.
Sure. I'll just start with a quick background on some of the accounting guidance. Jesse already mentioned ASC Topic 820, fair value measurement. That lays out the groundwork for financial reporting. What is fair value? I'm going to read the definition again because I think it's important to understand some of the elements that people look at when they're doing the fair value. So again, it's the price to be received when you sell an asset or paid to transfer liability in an orderly transaction between market participants at the measurement date. So the three elements there, an orderly transaction. So this is not a distressed sale. This is not a fire sale, liquidation sale. It's a normal course of business, orderly transaction. It's also between market participants. So it's not related parties moving something from a fund to a fund or a friend to a friend where we're going to do this deal and then we'll do something else on the other side. So it's unrelated parties, market participants, and then it's at the measurement date. So I think one of the issues in delivering valuations is explaining that, well, we're not going to look at when you exit the investment according to your plan of 2-3 years down the road. It's what could you do today in an orderly transaction today. So it's those elements need to kind of stay in top of mind as you look at it. So ASC 820 also lays out a hierarchy of inputs and different assets. I'm sure a lot are familiar with the level 1, 2, and 3 assets. Level 1 assets, readily marketable, publicly traded. It's something on the New York Stock Exchange, for example, pretty straightforward. Level 2 assets may have some observable inputs. They may be pink sheets. They may have broker quotes, or they may have a very similar security that is on public market. And then level 3 assets, no publicly traded market, unobservable inputs. You would think of private equity, private debt, distressed debt as some examples. And that's where, as we've been talking about the valuation process, so the entity that's doing the fair value has to use assumptions about what other market participants would assume if they were going to do an orderly transaction. And then just to today's discussion, you might think that level 1 assets would be the most straightforward. You would never have any issues, but as I think we get into some of the cases, you can see the fraud and the manipulation even with something that you would think would be very straightforward. Amit, you want to add?
Sure. I mean, what I would add is what we come across is many times beside level 1, there is a thin line between level 2 and level 3, right? At times when you get broker quote, questions are raised around whether it's a level 2 versus level 3. And normally it's very important that each organization, each fund has a decent leveling policy, which clearly lays down all the scenarios based on which how you'll consider something level 2 versus level 3. For instance, normally we evaluate whether the input is available based on market transaction and is available to market participant or not. Is the input something which you obtained from outside the organization? And is the input available based on a recurring basis? So here input could be that quote, right? And then the quote should not be like one time you got multiple quote and you called it level 2. And next quarter or next year you want that quote and you don't get it, right? Which clearly is an indication that perhaps this is more thinly traded and should be level 3. So as you're evaluating level 2 and level 3 investment also, it's very important that you properly document your policies and procedures. As said, right, in some of the discussions, there has been enforcement action where you have overvalued things, right? So many funds tend to take conservative estimate and put everything as level 3. Accounting principles don't allow you either, right? So you have to make proper judgment and ensure your policies and procedure clearly lays down how you will go about identifying something as level 2 versus level 3. I would also add, right, around some of the challenges which you face in valuation, right? As you're valuing hard to value assets, right? These are illiquid names, and it's important to understand, right, what kind of assumptions goes into it. We work closely with independent valuation firms to evaluate those investments, and it's very important that as you're going through those unobservable inputs, you are evaluating what kind of changes can happen, right? I mean, the guidance ASC 820 lays down clearly around different approaches which one can take, either an income approach or a market approach or an asset-based approach. And many times for a specific valuation, we use multiple approaches. And what at times we have found is also that that you are doing both the approaches, but you're not reconciling the approaches. So it's a good step to do multiple approaches, but it's also very important that you reconcile, because eventually both approaches should give you the same value, because at the end, fair value will be a one number which will go into your financial statement. So that's very important to kind of ensure that that's happening. At times, you are using in a market approach, you are using public comps, and those public comps could be much larger companies which are much bigger in size and have grown much more than what the portfolio company you are trying to value. And it's very important, again, in those scenarios, you adjust the public comp and adjust the valuation accordingly based on that portfolio company which you are trying to value.